Here in 2026, oil markets are pulling traders in 10 directions at once. OPEC Plus keeps tweaking output quotas, U.S. shale is still punching above its weight, and central banks are finally easing rates after years of hiking. Sounds like good news for cheap oil, right? Maybe. But here is the thing. A team of IMF economists figured out back in 2016 that cheap oil does not automatically mean a stronger global economy. And that lesson? It is absolutely still alive today. If you trade oil futures, crude spreads, or even energy sector equities, you need to understand why cheap oil sometimes backfires. Because that why is going to shape your next trade. Pillar 1. Cheap oil is not always the gift. You think it is? Let us start with the big puzzle. Between 2014 and 2016, oil prices crashed about 65%. Huge drop. Most economists, including the IMF team who wrote this piece, expected that to act like a giant tax cut for the world. The logic is simple. If you pay less to fill your gas tank, you have more money to spend on other stuff. Oil importing countries, think Europe, Japan, most of Asia, should have been popping champagne. But they were not. Growth stayed slow. Consumer spending did not jump the way the model said it should. The IMF literally had to ask, where are the positive effects? Why is the gift not being unwrapped? The answer comes in layers, and each layer is a trading insight. Pillar 2. Supply versus demand, the root cause, changes everything. Here is a concept every oil trader needs to tattoo on their brain. The reason prices fell matters just as much as the fact that they fell. Think of it this way. If oil is cheap because the world suddenly got really good at producing it, more supply, then lower prices can genuinely be a boost for buyers. But if oil is cheap because the global economy is slowing down and nobody needs as much fuel, weak demand, then cheap oil is just a symptom of a sicker world, not a cure. Back in 2014 to 2016, the IMF found it was a mix of both. OPEC was pumping at record highs. U.S. shale turned out to be surprisingly tough. Producers kept pumping even when prices fell, because they had already spent the money drilling the wells. But at the same time, global growth was cooling off. So you had a messy combination: extra supply and weaker demand pushing prices down together. Why does this matter for your trade today? Because if you see oil drop and you assume great lower costs, economy will boom, you might be wrong. You need to ask, is this a supply story or a demand story? Those two scenarios send totally different signals to equity markets, currency pairs, and rate expectations. Pillar 3. Oil exporters take a bigger hit than you expect. Here is something that surprised even the IMF. Oil exporting countries, think Saudi Arabia, Russia, Nigeria, Iraq, only make up about 12% of the global economy. Small slice. So when their economies got hammered by cheap oil, you might think, no big deal for the world. Wrong. The damage from oil exporters was the single biggest reason global demand forecasts had to be revised down. These countries did not just earn less money, they cut spending hard and fast. Government budgets got slashed. Big infrastructure projects got canceled. Private oil companies around the world cut their exploration and drilling budgets by roughly $215 billion between 2014 and 2015. That is like turning off a huge engine of global investment all at once. The ripple effect hit even oil-importing countries, including the United States, which lost a ton of energy-related investment jobs and spending, even though Americans were paying less at the pump. The lesson? When oil crashes, watch the exporters bleed first, and watch that bleeding spread outward through investment channels you might not have connected to oil at all. Pillar 4. Interest rates, change the entire equation. This is the most important and most underappreciated pillar in the whole IMF piece, so stay with me here. Normally, cheaper oil means lower inflation. Lower inflation is usually good. It keeps your purchasing power strong. But here is the twist. When a central bank's interest rate is already near zero and cannot go lower, something strange happens. Falling oil prices push inflation expectations down even further. And when inflation expectations fall, but the interest rate stays stuck at zero, the real interest rate, what you actually pay after adjusting for inflation, goes up. A higher real interest rate slows borrowing, slows spending, and can actually shrink the economy. Cheap oil accidentally becomes a drag. Think of it like this. Imagine you lend your friend $10 and they promise to pay you back $12. But inflation is running hot, so those $12 are worth less in real terms. That is normal. Now flip it. If prices are falling, those $12 are worth more than you expected, which means your friend is actually